Hi, everyone. I wanted to spend a few minutes talking about portions of the original lecture that have been updated for 2020. So throughout the entire lecture, we learned about depreciation. We learned about immediate expensing, section 179 of capitalized assets, certain ones. And we also talked about bonus depreciation. And those items all still hold true for 2020. It's just some of the maximum amounts you can take have been updated for 2020. And I did not update those in my original lecture, which was, I recorded that 2 years ago. So, and it's a long story as to why I didn't. I lost my whole flash drive, but that's another story. So I'm doing this little addendum so we can go over these items using the 2020 numbers. So as we talk about in the lecture, immediate expensing of assets that are purchased that are normally capitalized and depreciated are allowed for certain businesses. And we call this section 179 expensing. Now I am in your book back on page 10-17. I want to bring to your attention in the lecture, we said it was up to $1 million of purchases this year, and that's new and used that are considered more personalty assets. Certain qualified property includes real estate, certain types, but for the most part, it's new and used personalty assets, non-real estate assets. You can expense up to $1,040,000 of purchases. So back in 2018, it was only $1 million. Now it's up to $1,040,000. So they just updated that number. All the other rules still apply. So the example in the book presents you with Teton. They purchased computer and information system, which qualifies for section 179. That's a qualified property. So is a delivery truck, so is machinery. They're all personalty assets, non-real estate. So Teton here has decided to just expense $800,000. So you do not have to use all $1,040,000, but you can use whatever dollar amount you want, or you don't have to use it at all. It's available. So they only decided to expense $800,000 of this machinery this year as section 179. What we want to make sure you understand is they didn't expense the entire 1.2 million. They paid for this particular machine, which is up here. There's their machine. So they still have $400,000 of cost that has not been expensed. So now in the same year, they could go and calculate maker's depreciation on the remaining cost. Now, something very important to remember is next year, when they're calculating depreciation expense on this machinery, they will use this $400,000 as the new quote cost to calculate future makers. This $800,000 is gone, it's expensed, but this $400,000 will be expensed over the life of the machine. Now, in this second example, Teton was eligible for and elected to claim the whole $1,040,000 on the machine. Well, how much depreciation expense will they have on this machine, assuming this machine qualifies for half year, which I'm just going to scroll back up. None of these assets were purchased in the fourth quarter. So they are eligible for half year convention. So 1.2 million is the machine. Expense all 1,040,000 of it immediately, but you still have 160,000 of costs left over. That's your new basis that you will calculate future makers on, but you start with the first year, this year, so 14.29%. So the total depreciation in year one on this will be the section 179 plus the part that is allowed to calculate maker's depreciation. Now, just like in our slide presentation, there are limitations. First of all, your expense, the amount of Section 179 expense you take, cannot create a net loss in your business. But also, the amount of Section 179, the maximum amount that you can claim, statutory amount is $1,040,000. But once your qualified property purchases is above $2,590,000, you must reduce that maximum statutory amount for every dollar of qualified property cost above $2,590,000. I think in our slide back in 2018, it was 2.5 million. So they're just increasing it. So if we see this in action, assume during the year, Teton placed in service this 2.4 million of machinery, 920,000 of computers, and 80,000 of delivery trucks. So the total amount of qualified property for Section 179 is 3.4 million, well above the maximum that you can purchase before your expense amount, that maximum expense, is reduced. Now remember, this is only qualified property. If they bought any buildings or real estate, we wouldn't include that in this calculation of 3.4 million. So now, what was the qualified property placed in service? What's our threshold? And that's the statutory amount of 2,590,000. So how much do we reduce the maximum Section 179 expense amount? By the difference of 810,000. So if these purchases were less than 2,590,000, they would be eligible to take 1,040,000 in immediate expense. But because the total purchases of qualified Section 179 property is above the threshold, we must reduce that 1,040,000 by the amount the purchases are above it, 810,000. So they're still allowed a Section 179 expense on, their equipment or their machinery or whatever, but it's limited to 230,000. Okay, so now when they calculate Section 179, or I'm sorry, the depreciation on a machine, let's say they decided to take all 230,000 on the $2.4 million machine. Well, they could expense 230,000 of it, and then whatever's left over of the 2.4 million, they'll depreciate using makers, just like we did before. So I wanted to make sure we understood that. One last thing, as I said, you cannot create an expense in your business. So let's go to example 1013. Let's assume the same facts in example 1012, where the maximum amount of 230,000 is for expensing, and we apply it against the machine. Further assume that Teton reports 400,000 of taxable income before deducting any Section 179 expense and depreciation. What amount of total depreciation, including Section 179 expense, is Teton able to deduct on the machinery for the year? So we're going to assume there's the 2.4 million. They deduct the 230,000 as Section 179. They have a remaining amount to depreciate of 2,170,000, depreciated using makers. So they calculate 310.93 as their depreciation. First, subtract that depreciation from their taxable income of 400,000. So of the 230,000 in Section 179 expense, they're only allowed to take the amount this year that would result in a zero taxable income. Do they lose that other 140.93, no, they carry it forward and take it next year. But this year, since it would cause a loss in their business, they're not allowed to take all 230,000. Okay, and that goes on and talks about that. Okay, so that's section 179. Okay, so that's a great example to run through as well. The other example, which you didn't change at all, is bonus depreciation. That stands. So we're still depreciating or are allowed to use bonus depreciation up to 100% of the cost. And you're actually expected to on qualifying property. And if you don't, you should elect out. You have to ask for permission not to use it. So there's the qualifying property talked about, and there is the different amounts. Okay, so I wanted to make sure we went through that. We talk about listed property in our discussion, and we talk about specifically automobiles. And I just want to let you know all that information remains the same, except the maximum amounts allowed for depreciation each year. So back in 2018, the maximum depreciation expense on a luxury automobile when you were using makers or section 179 is $10,000. It's up to $10,100 for 2020. You add another $8,000 if you're electing bonus depreciation in that first year on that automobile. And you could see how these amounts differ from those originals. So I just want to bring that to your attention. Everything else is the same with those computations. Okay, so there's some great examples in here. So if you have any questions on this, throw them out on the discussion board. Now, this is what I really wanted to take a look at with you guys. At the very end is a great comprehensive example. And I want to spend a few minutes on it because you're going to have to complete the tax form for depreciation. So in this example, this company, Teton, it's all the different assets they purchased, and they even tell you where to refer back to the examples for the calculations. But in 2019, remember, that was last year, because we're working on 2020 in this example. They already had 5 assets. None of the assets had any section 179 taken on them or bonus depreciation last year. They don't qualify for either one this year, only new purchases this year. And when I mean new purchases, I just mean a purchase that occurred this year, qualify. So we're just going to take each one of these assets, determine its life, like the machinery is a 7-year, office furniture 7-year, the delivery truck is 5 years, the warehouse will be 39 years, and then the land doesn't have depreciation. And we'll go to the second percentage. Let's see, and none of these assets were purchased in the 4th quarter, so it looks like they all use the half-year table, and we apply the appropriate percentage. And back here to this, there is the calculation for the various items. Okay, so example 10.5 shows us that 2nd year depreciation calculation. Let's see if I can go back. Of course not. Let me go back. Okay. Go right to that example. There we go. Okay. Example 10.9 shows you the warehouse. But remember, that's the 2nd years. So make sure you can compute those. Now, in 2020, this company had 3 major asset purchases. None of them were in the 4th quarter. And the company decided to only use section, and so this is the order you're going in, section 179. They're going to take 80,000 of the delivery truck and expense it as section 179. They're going to take 960,000 of the machinery and expense that under section 179. As long as they have the proper, a legitimate amount of net income so that they could expense all of that. And also, as long as they've purchased, the 2,590,000, which I believe they did here. Yeah, they purchased 2.2 million only. They could take all 1,040,000 immediate expensing. Then, if there's any basis, take a look, any cost or basis left over, look at that machine. Now they could expense it under bonus depreciation, and they elect to. We're going to expense all the computers, and there's no net income limitation on that. There's no, you bought too much limitation. Just as long as it's qualified property for bonus depreciation, you could expense it. So if there was any real estate in here, we'd have to be careful and make sure, does that real estate qualify for bonus depreciation? Okay, so you got to just be very aware of that. So look at this, in our final columns, we don't have any basis, any cost remaining to calculate regular maker's depreciation for any asset purchased this year. Well, that's okay. We do have section 179 and we have bonus depreciation. So this is a great table to use or to create in order to complete your 4562, which is the tax form to compute or to report depreciation. This form reports prior year information in totals only. So on this form, we're not showing all the assets from before 2019. We are just going to focus on assets purchased in 2020 as far as details go. For instance, section 179 expense is part 1. So if the company decides to section 179 expense any asset in the current year, I know this is 2019 on the tax form, but it is the 2020 tax year. We will say, okay, what's the maximum amount for this year? And that's the statutory amount, 1,040,000. Okay, what was the total cost of all the property, section 179 property placed in service? 1,280,000. Okay, what is the total amount that is the maximum you can buy before we start reducing your section 179? 2,590,000. Okay, well then none of our section 179 maximum amount is reduced. That's line 4. You would subtract take line 3 minus 2. That would be a negative amount, so it would be 0. Take line 1 minus line 4, and that's the maximum section 179 expense you can take. Now we're going to show what property we purchased this year we will be taking that expense on. So here's the machinery. We paid 1.2 million for it. We're going to expense 960,000 of it. And the delivery truck, we paid 80,000. We're going to expense 80,000. Add those two together, that's line 8. Line 9 says, okay, enter the smaller of line 5 or 8. Well, they're the same. Line 10 is if you had any section 179 from last year that wasn't allowed. Well, we have none. The business income limitation is our next line, and we're going to leave it at 1,040,000. And then line 12, 1,040,000. So we could take all 1,040,000. Next part. How do you report prior years, or I'm sorry, bonus depreciation? That's our next part. Bonus depreciation. Take a look. It says special depreciation allowance for qualified property. So we don't list each property here and the amount of bonus depreciation specifically on the form. We just say, okay, we are taking 920,000 plus 240. 1,160,000 of bonus depreciation. Line 17, maker's deductions for assets placed in service prior to 2020. That should be 2020. So that's where we will add up all of the amounts, whoops, right here in depreciation expense from all the assets purchased prior to 2020. Add up those amounts and we report them as one large dollar amount. Add line 12, line 14, and line 17 to get line 22. Now, one thing that isn't in this example that I want to talk with you about. What if you had an asset purchased in 2020 that you did calculate maker's depreciation on? Or what if you had a few 5-year assets? You would report them, in line 19 and lines 20. Well, specifically line 19. So if you have any 3-year property, you're going to report how much basis you're calculating depreciation on. So let me run back. Let me see. I'm going to take you back to page. Go back to page 10-18, where we were looking at an example, the top example, where we had a machinery that we said we're only going to expense $800,000 of it in section 179 up here. That would have been reported up in this area. The machinery has remaining basis that we're calculating maker's depreciation on, and this is its first year. So we say, well, what's the life of the machine? 7 years. So we would put $400,000 in the basis. The recovery period is the life of the asset, so you would put 7. Convention is if it's half year, so you would put HY, or mid-quarter. Since you have a choice, they don't populate that. Well, this would be half year. The method, DDB, double declining balance. And then you would enter, whoops, sorry, I didn't mean to do that. My finger just clicked. In the very last column, you would enter the 57,000, I did it again, the $57,160, the calculation of maker's depreciation on this asset you bought in the current year. Now we don't list, say you had 3 machines, you would take all of their basis used to calculate depreciation expense under makers, add it together and enter it in the first column, then 7 year, then the convention, then the method, and the total amount of depreciation calculated in the first year. Be careful. Let's say you have real estate. For instance, let's say you bought a $100,000 warehouse. Here, you would need to, first of all, decide, is it residential rental property or non-residential? Obviously, it's non-residential. You would put the month and year it was purchased. You would put the basis, so how much you're calculating depreciation on. There's only one way of calculating depreciation on this type of property. Over 39 years, using a mid-month convention, straight line. And then you would put the dollar amount. So I believe in your graded tax return, you may have to enter information into this 4562 in this area. Remember, you only enter information in here if you're calculating maker's depreciation on assets purchased in the current year. Prior year maker's calculations are added all up and entered in line 17. And when I say prior year, I mean purchases in prior years. Okay, so I wanted to make sure we reviewed that so that when you're approaching your graded tax return, you're familiar with where information goes. If you have any questions, please post them to the discussion board.